Welcome to the Explainer. So, if you've been watching the markets lately, you know the usual playbook for tech and manufacturing, right? It's literally just grow at all costs. Grab market share today, figure out how to make money eventually. But what happens when a company completely flips that script? Like, what if management looks at a massive chunk of their historical revenue and just says, you know what? We actually don't want this anymore. Today, we're tearing down the wild transformation of Knowles Corporation. We're going to track their latest financial data right through the first quarter of 2026 and see exactly how this bold strategy is playing out in real time. Let's get into it. Okay, so how do you increase profits while ditching a core business? I know, it sounds totally counterintuitive, but we're looking at a masterclass in how a company can strategically shrink its top line to massively blow up its bottom line. In corporate speak, they call this addition by subtraction. For years, Knowles was the go-to for cranking out huge volumes of parts for everyday consumer electronics. But honestly, those markets are brutal. Sure, they're huge, but pricing power is basically non-existent. It's a total race to the bottom. I mean, think about how cheap replacement earbuds have gotten. So Knowles had this aha moment. They realized that to unlock real shareholder value, they had to change their actual DNA. They needed to stop fighting over volume and start competing on pure mission-critical value. Making that shift meant saying goodbye to the old Knowles identity. They had to cut ties with the highly volatile, heavily commoditized world of cell phones and cheap earbuds. Enter New Knowles. This version of the company is hyper-focused on medtech, aerospace, defense, and industrial electrification. We're talking about high-performance capacitors, RF filters, and crazy advanced miniaturized tech that actually goes into life-saving medical devices and defense systems. You know, markets where failure literally is not an option. And because it's so high stakes, customers are more than happy to pay a premium for extreme reliability and custom engineering. So the real spark for this whole transformation was selling off their consumer MMS microphone business, those tiny audio sensors, to Syntiant for roughly $141.9 million. And look, this wasn't just some minor housekeeping divestiture. This was Knowles intentionally cutting off a major limb of its legacy business. The deal closed right at the end of 2024, bringing in a mix of cash and preferred stock. But honestly, the money wasn't even the biggest part. It instantly changed the company's entire financial DNA. By dumping a lower margin, high volume segment, they essentially cleared the deck. Now they can pour all their resources, all that top tier engineering talent, and their factory capacity into the high margin stuff that actually defines their future. It is actually super fascinating to see how CEO Jeffrey New framed this move. Notice how he doesn't talk about it like a loss? He pitches it as a deliberate evolution toward higher value. The exact wording here is super intentional. He calls Knowles a premier industrial technology company. That is a massive shift. That signals a totally different valuation multiple and attracts a completely different type of investor than some consumer electronics parts supplier. Management is basically shouting to the market, hey, we are no longer riding the crazy roller coaster of consumer tech demand. Instead, they're locking themselves in as an indispensable partner for long-term massive growth trends like medical miniaturization and defense. This whole pivot caught the eye of investment firm Diamond Hill, who recently bought in. They're betting that this exact shift toward resilient, high-margin products is going to drive serious earnings, even if overall revenue growth is just kind of moderate. Wall Street analysts are dubbing this the mission-critical margin story, and the thesis here is incredibly straightforward, but man, is it powerful. Think about it. If you're selling custom, highly complex parts to a defense contractor or a medical device maker, they are not going to just swap you out to save a few pennies. The switching costs are way too high and the regulatory red tape is insane. Because those relationships are so sticky, Knowles doesn't need to post crazy double-digit revenue growth every single quarter to print cash. They literally just need to execute on the high-margin products they already have. And we can actually see this playing out right now in their Q1 2026 earnings. They pulled off this massive swing, going from a $2 million net loss at this time last year to a $9.7 million net income this year. They generated over $153 million in revenue for the quarter, so this turnaround is absolutely working in real time. And remember, they just did this right after getting rid of a massive revenue-generating business unit. The fact that they can flip a $2 million loss into nearly $10 million in pure profit while their top-line revenue is still recalibrating, that just goes to show the insane operating leverage they've unlocked. They are literally doing way more with way less. All this operational discipline led to a massive 50% jump in earnings per share. If you dig into the SEC filings, specifically their Q1 2026 10Q, the gross profit improvement just jumps right out at you. And the best part? This wasn't done with weird accounting tricks. It was pure, fundamental execution.
They slashed their interest expenses, totally optimized the cost for the remaining products, and seriously ramped up shipping volumes for those target high-value sectors. I mean, a 50% EPS jump, that's exactly the kind of number that makes institutional investors, who might have ignored the stock before, sit up and pay very close attention. Let's zero in on the medtech segment for a second. Their operating margins, or EBIT, expanded beautifully, climbing from 32.3% up to 38.2%. Let's just pause on that. For a hardware manufacturer, that is practically bordering on software-level profitability. And according to their financials, this huge margin jump wasn't just luck. It came from dialing in a highly favorable product mix and getting their factories running way more efficiently. Because when a factory is perfectly optimized to pump out premium products at high capacity, basically every extra unit they make drops straight to the bottom line. Now that profitability is surging, management is shifting gears to reward the shareholders who stuck around for the ride. And let's be real, when a company goes through a multi-year restructuring, it asks for a ton of patience from its investors. But now that the cash flow is looking rock solid and this high-margin thesis is actually proving out, Knowles has to figure out what to do with all this capital. They've definitely been reinvesting in themselves, specifically expanding factory capacity for their specialty film products, but they've also made a very firm commitment to returning cash to their equity holders. Case in point, Knowles bought back $7.5 million of their own common stock in Q1 alone, and they still have a massive $121.5 million left in their buyback war chest. In total, the board authorized up to $400 million for share repurchases over time. When a company is aggressively buying up its own stock, especially when it's trading around the mid-30s, management is basically screaming to the market, "We think our stock is way undervalued compared to what we can earn now." Retiring those shares shrinks the overall share count, which mechanically drives up future earnings per share. It's a fantastic flywheel effect for the investors who are still holding. But hey, we've got to look at the whole picture here. As the analysts over at Simply Wall Street pointed out, this story definitely has some risks, namely potential factory inefficiencies and ramp-up costs. Scaling up production on highly complex, hyper-precise components like specialty films and inductors for defense and medical uses, that is incredibly tough to do perfectly. If Knowles hits manufacturing snags, scrap costs could spike and start chewing into those beautiful margins we were just admiring. Plus, even though the current product mix is fantastic, any big macroeconomic bumps in the industrial or defense sectors could push demand back toward their slightly lower margin items, which would definitely pressure their forward guidance. Even with those hurdles in mind, I think it's incredibly telling that the broader market consensus is still a solid, moderate buy. Out of the 5 major Wall Street analysts tracking the stock over the last year, sentiment is very clearly leaning positive. 3 buys, 2 holds, and 0 sells. It's actually pretty revealing that even the most conservative analysts out there are just saying to hold. Literally no one is pounding the table telling you to sell this thing right now. The market clearly sees and respects the structural upgrades to the business model. The only real argument left is just figuring out exactly what that new structure is worth. And looking at the heavy hitters, top-tier brokerages are placing their price targets right around the $38 to $39 mark, which lines up pretty closely with where the stock is trading right now. For example, Robert W. Byard recently bumped their target up to $39 with an outperform rating, and Craig Hallum held steady on their buy rating with a $38 target. Now, when a stock's actual price hugs Wall Street's near-term targets this tightly, it usually means the market has already fully digested the good news. It tells us that the current valuation is probably fair, at least based on what the company just proved it could do in Q1 of 2026. And that brings us right to valuation. Right now, Knowles is trading at a forward price-to-earnings ratio of about 27.8. Now, in the traditional manufacturing world, that is definitely not cheap. But investors are happily paying that premium because they believe the quality of Knowles' earnings, which are now locked in by those sticky medtech and defense contracts, is just miles ahead of the wildly cyclical earnings they used to rely on. People are basically paying up for stability, predictability, and a brand new margin floor. So, I'll leave you with this to chew on. Has Wall Street already priced in the success of this turnaround, or are we literally just scratching the surface here? Knowles pulled off one of the absolute hardest moves in corporate strategy. They shrunk the company to grow the profits. But the big question now is whether this 27.8 forward multiple is the finish line of their turnaround, or just the starting line of a massive multi-year industrial supercycle fueled by AI infrastructure, defense spending, and next-gen medtech. Look at the data, weigh those risks we talked about, and decide for yourself if this margin story still has room to run. Thanks so much for joining me on this explainer, and I'll catch you in the next one.